Hello, everyone. Today on the final bar, we'll do our normal Monday routine, hitting the market from three directions: top-down macro, bottom-up stock picking, sector rotation. A lot of things moving around. A quick sell-off out of the open today looked like it could be very dire all of a sudden, but the rest of the day really coming back to normal. Small caps still weighing pretty heavily on the rest of the market, though. So we're going to look at some differentiation between the larger and smaller names in the universe. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of stock charts, using data visualization, the message of the markets themselves, supply, demand, fear, and greed. All of that is manifested in the stock prices. And our goal is to understand the trends, identify those trends, follow those trends, and anticipate when those trends are exhausted. And here we're in, I was doing an interview earlier and they asked about rotation and what that really meant. And, what I described to them was, for me, rotation is when things had been outperforming and now they're not. And when things had not been outperforming and they start to. And we've certainly seen that in many different ways over the last 6 months, for sure, right? As different groups have taken the leadership role and kind of pushed higher. And also when things have rolled over. And I think we're still, as much as we want to focus on the message of every single day, I think if you step back and look at the average chart, overall not bad, but a lot of choppiness, a lot of uncertainty in the short term. Today, with a big distribution out of the open, a big rally to finish off in decent shape for a lot of indexes and a lot of stocks, tells you something about where we're at. We have some great guests coming through the show. Last week was a lot of fun with some of the comments we heard from our guest. This week on Tuesday, the 30th, we have David Auerbach from the Daily REIT Beat. On Wednesday, the 31st, JC O'Hara from MKM Partners in New York. And then on Thursday, April 1st, Matt Tuttle, founder of Tuttle Tactical and manager of ETFs like the SPAC ETF, the upcoming FOMO ETF, and many other trend following ETFs. All next week. We'll take Friday off for the long holiday weekend. I hope everyone has a great Easter holiday. And then next week, I will be off taking my family to the remotest parts of Oregon where there is no internet or cell phone signal to decompress a bit. And I have some great guest hosts that are going to come and take the show for me and walk you through the daily market activities every day after the close. Aaron Swenlin will take the first shot on April 6th. Let's continue on with our market recap. As I mentioned, sort of a mixed day. How many times in the last couple of weeks have I told you where the NASDAQ was down, the Dow was up, or the reverse of that? The Dow is down, the NASDAQ is up, and the S&P is in the middle. This is that rotation. When we talk about rotation, you see this choppiness, the cyclical pattern favoring sort of the, industrial, energy, financial, materials sort of group, or technology, more the growthy areas of the market. And one of those tends to lead, one of them tends to lag. I think the NASDAQ tends to be down more than the Dow over the recent last couple of weeks, but overall you've seen that. And the S&P sort of chopping around in the middle. So S&P not far off of all-time highs. That's a thumbs up. Overall, the advanced decline lines continue to be positive. That's good. But you're not seeing leadership from technology for sure. You're also not seeing leadership from small caps. So on the day where the S&P ended essentially flat, small cap index, S&P 600 down 2.6%, mid caps down 1.8%. So, where it has not been a good place to be in the last couple of weeks has been small cap growth or small cap value, both of them struggling a bit. It's been better to be larger overall. However, the long-term trend still certainly very much going toward small cap. We'll look at that chart in a second, and you'll see what I mean. The VIX back up nearing 21. Looking at some other asset classes very quickly, the long bonds continued their downward push overall, with the TLT down 0.9%, 10-year yields back to around 172. The dollar index was up about 0.25% using the UUP. Commodities actually finished in the green. I'm not sure how, because earlier in the day, it was a big sell-off relative to where we closed Friday, but then just chipped away and sort of accumulated. So you have this continued accumulation out of places of weaknesses for equities and commodities today. Where we did not see improvement was gold and silver. So precious metals still, weighing down pretty good. Cryptocurrencies, green across the board, all in the positive. Bitcoin up around 57,600, almost there. Let's look at some charts and we'll come back to some other themes for the day. So here's the chart of the S&P 500. Again, I'm often asked, what's the situation? Are we bullish or bearish? And I think, I don't like to say I'm neutral, but it's kind of where we're at, right? We've gone nowhere in the last month, right? Even, month plus. Now, don't get me wrong, we've made higher highs. That's true. We made a new all-time closing high. That's true. We're, threatening a new all-time closing high, still continuing to test that 4,000 level. But I can't help but notice that, this run that we had up into sort of the rounding area around 4,000, from there, it's been very choppy with some of the things like the NASDAQ breaking down, small cap index coming off pretty good. So while the overall S&P 500 is holding up, it's not everything. Now, some things are certainly working, and when we get to our stock specific portion of the show, we'll talk about that. So big picture themes to think about. Again, this pink line on the chart is what jumps out me from the S&P 500 chart. This bearish divergence of lower highs and momentum every time the S&P has made newer highs. That's what's one of the things that's caused me to want to lighten up on the accelerator. And this is not the environment to be looking for necessarily for aggressive new long opportunities. This is more the time to lock in gains and identify lines in the sand, identify when you might take profits. The reason why I would say that is because that same bearish divergence that you saw in the S&P, we're seeing that in a lot of indexes as well. Here's the Russell 2000 ETF. You can see the higher highs from February to March, the lower peaks from February to March in terms of momentum. So, small caps making new highs on lower momentum. Now, small caps came back a little more than the S&P 500 overall. On the Russell 2000 ETF, around 205 is really the key support. That's the low from January. It's right about where we hit the low from early March. We're now bouncing off of that area again. I think if that breaks, I think that would be concerning. Now, what's concerning to me already is the fact that other things have already started to, to break that level of support. This is a similar chart for the NASDAQ 100. Here's the low from the end of January. Here's the low from the end of February. We broke down through that in early March. We've actually already rotated lower. Here we had a bearish divergence back January to February. A lot of semiconductors had that as well. That causes me to certainly be cautious on the growth trade, especially technology, especially NASDAQ 100. I think we break above 13, what is this, 13,250 or so, 13,300 would be the swing high from recent weeks on the NASDAQ 100. If we get above that, I think that would indicate certainly a move back into the NASDAQ and back into the growth trade to some degree, which could certainly help push the market higher. But it's not just there. We're going to get to individual stocks in a bit. While I'm remaining with this big picture argument, I'm seeing a lot of bearish divergences. Here's the chart of JP Morgan. Chart of the XLF looks very similar to this. Higher highs going into March, lower peaks and momentum. So again, for me, identify the trends. The trends have been positive and remain positive for a lot of things. Following those trends, again, I think you lean into what's working and lean away from what's not working. Leaning into things that have good long-term trends, I have no problem with. There are a lot of stocks pulling back to 50-day moving averages. Those could be interesting charts to look at. We'll try to highlight as many of those as we can. Something like Comcast comes to mind in that bucket. There's a large bucket of those stocks. But anticipate when the trends are exhausted, and those exhaustion signals are what I'm highlighting here. I'm seeing a positive trend, positive breadth, but exhaustion signals in the form of divergences. And I think from the big picture, that's what concerns me. That's what leads me to expect limited upside, more churning, and more breakdowns. What I've not seen are things breaking down significantly through support. While the NASDAQ 100 broke down, it then popped right back up. The S&P has not broken down through 3,700, which would be the line in the sand. And as long as it remains above that, overall, things aren't that bad. That's our market recap for today. Just trying to hit on some of the key themes. Let's rotate next and go into sectors. Looking at the 11 S&P sectors where they're rotating. Just very quickly, I didn't get into what worked today, but interesting to see some very defensive plays at the top of the list. Utilities and then consumer staples. We'll look at both of those charts in a bit here, but both of those making utilities making a new swing high, consumer staples making a new all-time high last week and again this week so far. Communication services number 3. There are a lot of media names, sort of this hedge fund unwind, the forced selling that we saw at the end of last week with stocks like Viacom and Discovery coming off very, very heavily. Overall, the communication services sector still holding up pretty well. There's still some decent charts in there. Even something like a Verizon comes to mind as a good long-term trend. The bottom of the list today, energy at the bottom, then financials, then technology. So it's sort of a mixed bag of things, but again, I'm noticing defensive things on the top of the list. Let's look at the RRG chart, the relative rotation graph, and see how things are rotating around the benchmark in the middle there. And again, this is the 11 S&P sectors around the center point. If you're unfamiliar with this, Julius de Kempener created this. He's one of our StockCharts contributors. His show Sector Spotlight does a great job of describing this in a little more detail. Overall, things go in a clockwise motion. Further from the zero lines means a stronger relative trend. Closer to the zero line means it's closer in relative movement to the S&P itself. In general, you want things that are heading northeast. You want things that are into this leading quadrant, which tells you they're outperforming with improving momentum. What fits that category right now? Not much, to be honest with you. Industrials are actually reemerging on the weekly RRG. Communication services still in pretty good shape. Energy and financial is not bad, but they're sort of rotating down a little bit. So the ones that are, sort of pure in a good direction, I would have to say industrials and communication services. What's not working here? Consumer discretionary, healthcare, rotating southwest in that lagging quadrant. Things to watch. Real estate is an interesting one. I'm excited to talk to David Auerbach tomorrow. He's the editor of Daily REIT Beat and always brings some good real estate REIT sort of ideas. It'll be interesting to hear what he thinks about that group. Given the environment, given the rotational patterns that we've seen. Consumer staples, by the way, is back in the improving quadrant, and those are some of the charts that are improving the most on a relative basis. Just looking at the absolute charts. Looking at the daily RRG in the last couple weeks, this was all vertical, where you had things like energy and financials over on the right side, kind of coming down, and I'll rewind the rotation a little bit. This is what things looked like about a week and a half ago. Energy over here on the right, then financials still outperforming, but coming off on a relative basis by the fact that they're going down. That's not underperforming. That's more the momentum coming out of that trade. Industrials, materials, same thing. We fast forward and look at how these things are rotating sort of in that southwest direction. So now we have things like energy in the lagging quadrant. You have financials not quite there, but getting close. Industrials, materials, this is communication services, all sort of rotating southwest. What's improving in the short term? Utilities, real estate. I actually can't see everything that's in there because it's so jumbled. I think that's financials there. In green, which is heading up in that direction. And then finally, healthcare. So in the short term, you can see some things rotating more positive. And again, the things that I'm keen on pointing out would be, this is consumer staples, XLP and the XLU. These are defensive sectors that are starting to actually improve on a relative basis. Let's look at the 11 sectors using the candle glance page. And I'm immediately, as always, visually drawn to sectors that are working, sectors that are breaking out, sectors that are not working, sectors that are breaking down. None of the 11 S&P sectors are really breaking down. They're either making new highs, they're stable and going sideways, or they've pulled back to a degree. And if which of these look the least attractive just on the visual, it's technology and it's energy, things that have had good runs that have pulled back a little bit, but still overall not bad. Nothing on this page looks horrible. So what looks really good? Well, I'm drawn to consumer staples breaking above 67 on the XLP, getting above its November and December highs, making a new high on Friday and continuing to push higher today. When I screen through the members of the consumer staples sector, I'm finding charts that are working, and it's a lot of things that have not been working that we've not talked about in a while that all of a sudden are starting to go higher again. Things like Kroger and Smuckers and Tyson and Mondelez, and these are all charts that we haven't talked about a ton because they just haven't been that good on a relative basis, but actually starting to emerge and seeing some rallies. So I think it's worth noting, some of those that may be emerging from a period of underperformance to see if there's some opportunity there. I'll highlight utilities as well. That's down here. You can see utilities getting above its January, February highs today, sort of rotating back up. Now, these are still below their highs from February 2020, still below the November 2020 high. So still some work to be done for utilities to be truly impressive, but I'm seeing the relative strength rotate higher. The last time you had a long stretch of underperformance and a rotation to outperformance was back here in September, October. It lasted about 2 months, and you may not remember that utilities were such a good play here in September, October, because so many other things were happening. This is when the FANG stocks started to run out of gas and roll over. This is when energy, financials, industrials are starting to work, but utilities was actually a pretty good sector on a relative basis for this 2-month stretch. Then these other things just continue to push higher going into the new year. Utilities underperform. So the question is this the beginning of something further? Is this the beginning of something of a little more upside? Here's real estate. And again, this is now really testing the February 2020 high. So many sectors are already above that, but this is a group of stocks that have not been doing so. They've still been underperforming, but you see again, the relative strength making a new 3-month relative high, price making a new almost 12-month high. So I think that's an interesting sector to watch as well. So it's interesting that the charts that jump out to me as very constructive are very defensive sectors like staples, utilities, and real estate. Now, it's not all just them. Here's a chart of industrials in really good shape. And we've talked about infrastructure plays. We've talked about the PAVE infrastructure ETF and some of the holdings there. We'll try to hit on as many of those as we can with our limited time on the show, but this is a sector that continues to perform very well on a relative basis. The material sector is making a new price high. The relative strength has been less exciting here. And again, what that means is even though the price has been going up, you really haven't done much better than the overall market owning this sector. And again, the challenge with materials, it's a relatively small sector. There's not a lot of market cap. There are not a lot of big stocks in that space. And gold names are really weighing on there. Something like Newmont Mining, obviously not as ideal of a sector. Finally, I just want to highlight healthcare. I feel like I'm jumping all around, but the problem I've had with healthcare, despite the fact that the price continues to go higher, despite the fact that it broke out at the beginning, end of last year, going into January, pulled back right to a breakout level. That's all good and has now rotated back and testing the new highs. Look at the relative strength line, which for the last 8 to 10 months has just been in a consistent downtrend. And we've had some of these bounces before where the relative strength turns up a little bit. And on a couple of these, I remember drawing this pink line and saying, ooh, this might be the beginning of something. And sure enough, it sure wasn't. I mean, it just on a relative basis, continuing to make lower highs and lower lows. And I think that's the challenge when a lot of sectors are holding up on an absolute basis. Focus on the relative and see what's getting it done on a relative basis. Healthcare for the long term has not been doing so. We need to take a quick break. We'll be back with our next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close as we look at these markets together using the powers of technical analysis, behavioral finance, data visualization, all that good stuff. As a reminder, we'll do another mailbag segment on Tuesday's show tomorrow. We'd love to answer one of your questions on the air. We've had great questions from many of you about market structure, about investor psychology, specific technical indicators, even particular charts, tickers, symbols that you're looking at, how you set up a particular chart that you're interested in that you've seen elsewhere. Nothing is out of bounds. Let us know what you're running into during your own process. Shoot us an email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video that you're watching. We'd love to answer one of your questions on tomorrow's show. Also, as a reminder, check out the new StockCharts TV on demand. Go to stockchartstv.com, use your email, set up a free account. You can save shows that you're watching. You can watch them anywhere on any devices. It's a really well-designed website, and I'm very proud of our team for creating. Also, you can look us up on any of the app stores, Apple, Roku, Android, whatever it is, we're on there. So enjoy StockChartsTV.com, the new StockCharts TV on demand. Our next segment is called Shifting Stocks. So we've gone through this three-part process. Number one, the big picture. And again, for me, I'm sort of cautiously enjoying the continued uptrend. As always, I view later stage bull moves, which I would argue we're in, with a great dose of skepticism, because I have seen bull markets end before, and I've seen how things can roll over. And again, that maybe I'm early and that maybe I tap the brakes a little bit, but I would much rather do that than get completely caught off guard with a breakdown. So for me, this is the time to be reviewing positions, to be thinking about lines in the sand and identifying where there's opportunities and where there are opportunities to get out while you're still in pretty good shape. Second is with sectors. And again, I'm struck today when I'm doing my sector review really over the weekend is how some of the defensive sectors have actually emerged in pretty good shape. And consumer staples, probably the best example of that, a sector that most people have forgotten about, ignored for good reason, because it just hasn't been a great sector. All of a sudden, some of the names are actually starting to work. Some of the names that we've just forgotten about or not thought about, like Hershey's, because this haven't been good charts, all of a sudden starting to work a little bit. Having said that, let's get to our final segment, Shifting Stocks. This is more of a bottom-up exercise, looking at some of the stocks and themes that are emerging. The way that I come up with the names to look at in this process, very simply, this is part of the result of part of my weekly routine, which is to go through the S&P 500 charts one by one and actually look at each chart individually and make notes. And I have a notebook that I go through every week and jot down things that I'm seeing, jot down patterns, what looks like what else. And if you're looking to build your understanding on the equity of the equity markets and understand what's working and what's not, I can't tell you another example I think is going to work better than that. Go through a bunch of charts and try to go through the same list every week. Fellow analysts of mine that on the institutional side did that with great success. And I learned a lot from the discipline of their weekly and daily routines. Let's start jumping through some of the names that are coming to mind. The first whole bucket of things, and I might not be so great with going by sectors, but I'm just looking at different charts. I'm seeing a lot of things that are more pulling back to a 50-day moving average. Comcast is not quite there. Disney definitely is there. Alphabet sort of in this camp. What else is at a 50? Energy stocks, I would say, something like a Hess. We're not quite there. Maybe Marathon. I'm trying to think of Marathon maybe comes to mind. So you can see a lot. What's the consistent pattern with a lot of these different market phases, different trend phases, but they've had nice runs. They've pulled back in the short term to an ascending 50-day moving average. And maybe Alphabet is a really good chart to look at. This chart isn't broken yet. It's not, going up anymore. And that's why on a relative basis, it's come off in the last, 4 to 6 weeks. But however, it's not really making a new low yet, right? It's making higher highs. And the most recent up push was in February. We've not regained those highs yet. We just pulled back. We're finding support here right around 2000, which is a big round number, which often you will find stocks sort of magnetized to that big round number, because for a lot of investors, that's where they think, when you're changing that first digit, and it's a big one, 2000s down to like 1900, all of a sudden you think, hold on a second, is it really worth this amount? I mean, when you're hitting it from below, when you're reaching it from above, that's sort of the general thought process and why stocks will tend to rotate here. Here I see a chart overall that has been in a good uptrend. For the long term, it's been a good performer. On a relative basis overall, the relative performance has been okay. And now it's pulling back to an ascending 50-day moving average. If this trend is a consistent uptrend, if all is well, if things are good, and if this bullish phase is going to continue, stocks like Alphabet, I would argue, should be finding support at their ascending 50-day moving averages and rotate higher. It was messy back here in December to January. That's kind of what happened. Really didn't get much below the 50-day, and then we made new swing highs, and I told you things were all in the clear. When stocks like this don't hold their 50-day, all those ones that I just showed you, when they don't hold their swing lows and start to break down through their previous swing lows. So on Alphabet, 2000 is an alert that I've set that I will absolutely be looking at. Breaks below there and stays there. I think it tells you to be a little uncomfortable about expecting further upside from here. I think you need to expect more corrective sort of moves. So that's one sort of bucket of stocks that I would point out. There are a lot of other things, and these are a lot of things like a Verizon, which is not particularly an attractive chart over the long term. And I'll tell you that because the relative strength has been an absolute bear from the March low. It outperformed going into the March low and pretty much has been a dog since then. But in the last month, it's stopped underperforming. It's been sort of a market performer. And the question is, can it start to outperform in days like this? days like Friday, where it's breaking above previous swing highs, where it's getting back above moving averages, makes me want to believe a little bit that names like this could work. In consumer staples, I would argue you're finding a lot of things like that too. General Mills looks a lot kind of like the Verizon chart. We've had sort of a downward trend. The relative strength, again, has been just really painful going back to the March low. It's not underperforming anymore. And in the last couple of weeks, it's actually been starting to outperform. It's making new swing highs. So seeing stocks like that just start to emerge is interesting. I question names like that are still well below, significant resistance, and both Verizon and General Mills fit that bill. But I'm finding myself wanting to believe in those a little bit. Other things that are actionable. We've talked a lot about electric vehicles recently, and Ford and GM come to mind as, again, decent charts pulling back to an ascending 50-day moving average. Both of those are in that camp. What's interesting in the automobile space, compare those two charts to the chart of Tesla. And Tesla is sort of like if GM and Ford were back here and then they just failed at their 50-day and kept going lower. That's the situation Tesla's in. A very different environment from, chart A, Ford pulling back to an ascending 50-day moving average, and chart B, Tesla having already broken down through some of those swing lows and going down. Like I explained in the Chart Madness special a couple weeks ago, I would take Ford over Tesla here, which is certainly controversial if you're a big Tesla bull. But for me, I'm focusing on the charts, and I'm seeing more constructive patterns on the chart of Ford or GM than I am for Tesla. I'll tell you that's different the moment I see it. I mentioned some of the breakouts in consumer staples. We can't get to all of it, but I'll quickly go through ConAgra, CAG, Campbell Soup, CPB, sort of earlier, not quite breaking out, but not bad. This is Hershey's making a new long-term high, new 52-week high today. Kraft Heinz, same thing, not bad charts. And Kroger may be the best of them all. Maybe Kraft Heinz is a little better, but you take this little spike from early January out of the way, and it's breaking above its September high. So consumer staples are an interesting one. If you've not looked at that sector in a while, I'd encourage you to poke around, use some of the screens, look for some of the charts that are breaking to new swing highs, because I think there could be some opportunities there. That is all the time we have for the shifting stocks. I always want to go through so many more charts than we have time for, but we will save them for another time. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the commodity index. I'm doing an interview a little bit later today for Australian business television. We're going to be talking about commodities a little bit. The DBC overall, it looks kind of like the chart of the NASDAQ, maybe kind of like some of those pull back to the ascending 50-day charts we've seen. What concerns me about commodities, they've broken their swing low from the end of January, end of February, beginning of March, bounced to new highs, but then came off. The bearish divergence here is what stands out to me. Higher highs in price, lower peaks in the RSI. I don't know if we've given enough back after that, that momentum divergence, but that's certainly something I'll be looking at. The long-term trend, I would argue, is still very positive for commodities, but certainly in a choppy sideways period here. Chart number 2 is utilities. This is very much an echo of what I think we saw back here in September, October, when the utility sector hit resistance. It broke above its swing high. The relative strength started to improve. I remember drawing this green line and saying, wow, this actually could be the beginning of a stretch of utilities outperformance. Maybe that means we're at the end of the uptrend. Soon after, it made new highs in November, and then that was it. We haven't seen those new highs again, but I'm seeing a similar pattern where we're breaking to new relative highs, breaking above swing highs, and that's why it needs to be on our radar as trend followers. Finally, consumer staples. I pointed out some of the charts that are working. Again, I would take a closer look at some of those and see if they fit into what you're thinking overall. But I'm always drawn to sectors and stocks and themes that are making new price highs and where the relative strength is improving. And I would not describe consumer staples as that for a long time, but I find myself starting to do it with a lot of names like the ones we mentioned. In established uptrends are breaking out of pretty established bases. I'm not sure how much of a run these sort of charts we're going to have, but again, as a trend follower, I want to find emerging trends as they're happening, not come to them when they're very much later and potentially exhausted. Folks, that's our show for today. Thanks so much for joining us every weekday after the close for the final bar. As a reminder, go to stockchartstv.com. Here's your email, set up a free account, get all of our great content, great hosts, great expertise from any of your devices, and also on the web. Also want to point out, we have some great content on our YouTube channel. So if you've not, made sure you go to YouTube, check out the Stock Charts page and subscribe. We'd love to have you along that journey. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.